today we are going to talk about how to get started in real estate investing, some of the things that I learned and some of the things that I did to get started. But before we do that, we need to go over a little legal disclosure because we are not offering legal advice. So I'm going to read this quickly. Real estate investment results, its officers or members provide no legal or professional advice. You should always consult a licensed professional, a professional appraisal, real estate agent, or financial advisor when making any decisions regarding the purchase and sale in real estate. The information obtained from reir.co, real estate investment results, or its members is intended solely for general guidance and exchanging, buying, or investing in real estate, and does not constitute legal, financial, tax, appraisal, accounting, or other professional advice. Because real estate contracts, closing procedures, and disclosures are guided by state law, always consult a local professional wherever engaging in real estate transactions. So that is the disclosure. We got to tell that out for the legal beagles. And I want to kind of just go over the story of what really is where we're at now versus where I started. And I actually started in a market similar to this and could not find a deal to get done because it was such a hot market and I didn't have enough experience. So I'm going to give you some of the top tips. I'm going to talk about like how to spot a deal, the vital importance of the MAO formula. MAO is MAO, otherwise known as maximum allowable offer. It is tied to the R, which is after repair value. We're going to talk about how you can choose the market that you want to be in. We're going to talk about how to start and build your team and network, and then making offers and closing deals. To start out where I started was in 2000. I started studying in about 99, 2000. I didn't buy my first deal until 2008. It shows you that I'm a slow learner, but I consistently just plodded forward. I looked at a lot of houses before I actually, somewhere around 150 houses I walked through before I bought them. So you can really see I was a slow learner. But the reason I was struggling so hard is because we're in a hot market, and when you're in a hot market, it's harder to actually find a deal that can make money on, and that's really the biggest struggle. So even as I found deals that would work, my investor at the time that was helping was my father, and he would come in. I would look at about 20 to 30 deals, and then he would come in and look at the best 3 to 5. And the problem was he was not seeing the really bad ones, and so it was hard to convince that this deal wasn't a sideways. Long and short of it is, by the time I really was probably looking and walking through those houses somewhere in 2006, 2007. So even though I started studying before that, I wasn't really walking through a lot of houses before that. But I had pre-approvals. I could close on anything I wanted to offer on. And I did write several offers, but it was actually really slow. But in 2008 was my first successful purchase. And it was basically right when the 2008 was after the crash in reality, because the crash happened most other places a little earlier than that, but it was right when it basically just started to get in my market. My market is about 2 years behind the national market, and we're in La Crosse, Wisconsin, in the county is across Wisconsin. But the biggest thing that I learned from, and I learned a lot of my stuff from multiple trainers. Ron LeGrand is probably the best trainer that I've ever learned real estate information from. He actually is the trainer of most of the trainers. So almost everybody that's famous, even on HGTV, was trained by Ron LeGrand at some point in their careers. But how to spot the deals. The one phrase that I learned early on was the deal of a lifetime comes along every single day. The question is, are you ready to take it down? And so there is deals in every market all the time, hot markets and cold markets. That conversation I was talking about earlier about the guy that losing his house, he was trying to help him. And the really interesting thing is someone put that under contract yesterday, and so there was nothing I could do to help him. But it was a deal. It actually was a deal. There was about $80,000 in equity in his house, and that house is going to go close, it looks like. So even though we're in the hottest market, 4% market, there's still a guy losing his house out there, and somebody got a deal. And it has to do with, are you in position to actually take the deal down? So how do you get positioned? First of all, you're going to have to be able to get some type of financing or have the money ready to go. And then you need to know what a deal looks like. So let's talk about that Mayo formula. The Mayo formula is maximum allowable offer. It's simply the maximum allowable offer is the after repair value, and we're going to talk about that, minus the profit, which is a 20% baseline, minus holding costs, which is a 10% baseline, and then subtracting the fix up. So you can offer Mayo on a finished house, but at that holding and that fix up or that profit cost. But if there's any fix up required, you have to subtract that as well. So we're going to use a round number of 100,000 just for simplicity's sake. On 100,000, you would subtract 20,000 for the cost of the profit, 10,000 for the cost of hold. So your maximum allowable offer before you get to the fix up cost would be 70,000 bucks. So then you go, how much does it cost to fix it? Well, you get your tape measure out, start measuring all the windows and the carpet, and you find out that it's hard to stomach whatever number you come up with. And this is the truth. And this is actually one of the best tricks that I was taught when I first started looking at deals, because you can wear your stomach out thinking about whether you're right or wrong on the fix-up cost. But whatever the numbers you come to, so let's say it's $10,852 in carpet and windows and whatever else you're going to do to the property, whatever you come to on that number, if it turns your stomach at $10,852 or whatever I just said, what you do is you move it to 15,000. And then you think about it and say, am I comfortable with the fix-up being 15,000? And if you're not, you just move it to 20,000. Best trick I ever learned. I think Ron taught that, because what happens is you get stuck in measuring and rethinking and guessing. And the problem is there's never been a fix-up cost that was projected that landed on the number. It's a fact. Thousands of deals of investors I know, nobody's ever got it right once. So by being able to be comfortable about the number is what allows you to do one of the things we're going to talk about on the list, which is make offers. So on that Mayo formula, if it's $15,000, you take 70,000 minus the 15, and you are down to 55,000. If you're worried about being 20, then it's 50,000. All right. Then the next rule is you never pay Mayo. Okay. Meaning you have to pay less than, if you think it's 50,000, Mayo's 50,000, you have to pay $49,999 or less. Now, how do you get to that $100,000 mark? Because you need that number more than anything else. So what the $100,000 mark is called the after repair value. And this is where looking at the marketplace matters, because when you look at the marketplace, you'll get an average of what that house, square footage, bedroom or bathrooms, and location is selling for. Now, the reason we're using 100,000, just there's no, you can't hardly find a cardboard box for 100,000 anymore. So most of these deals are in the $200,000, $300,000, $400,000 range. I was just using those numbers for ease of math. So let's say it's a $400,000 house. Well, you'd subtract 20%. So you subtract 80,000 for your profit. You'd subtract another 40,000 for your holding cost. And from there, the fix-up cost would be subtracted as well. So if you subtract 80 and 40, you go down to 280,000 is the maximum allowable offer before you have fixed up costs. All right. So let's say the fixed up cost is 50,000 bucks. Then you're at 220,000. Now, when you go to look at that house and make that offer, the cost of all those things figured in is all you have to do is make that offer confidently with paying below Mayo. What happens when you get these numbers right is you get confidence to write the offers. And so making offers is a requirement to buy a house or any investment. You cannot ever get, as a matter of fact, the phrase is, I've never bought a house that I didn't make an offer. And so most investors, when they start out, they really struggle with worrying about the fix-up cost, whether they're going to make money or not, and where do I go in with my offer. And then a lot of people, especially when they get in a hurry, or let's say they looked at a lot of deals like I did and didn't have the formula to work off on. At some point, you just put your money in because you're tired of waiting, And then that's where people get hurt, is because then they buy the property wrong. And the rule in real estate is the investment that you buy is when you make your money. So when you buy, you make your money, you realize your profit when you go to sell or refinance. But you have to be buying right, otherwise you cannot make money. All right. So the context of making those offers, if you are not comfortable with the numbers, it will be very difficult making offers. And like I said, I looked at 150 houses before I ever bought one, but I probably only wrote offers on 40 or 50. So I didn't write offers on all of them. The interesting thing was and we're going to talk about team next, starting to build your team and network, because you will need teammates, which would be like realtors, other investors. You would need basically banks if you're working with banks or bankers and title companies, contractors. You're going to need these people to get what you want to get accomplished. And until you're comfortable with your own numbers, you kind of waste a lot of these people's time. Now, I was comfortable with my numbers. I wore out two or three realtors trying to walk through those 150 houses because I had my formula, but the market was out of whack. So because I couldn't get my formula to work in that hot market because I didn't have the experience, I would look at a bunch of houses and realtors would just get tired of showing me houses, and they wouldn't work with me. That may happen. You just got to keep plugging forward. The interesting thing is, when I got my first deal, it was because I came across an agent that understood that I was ready to go. All she had to do was make my numbers match. And she actively was just scrounging for the deal that would make my numbers match. And she got it. She actually found it. And it was actually her own listing too. I think she got it done because of the fact that I was pre-approved and ready to go. Now, here's the funny part about that story. I bought my second house on accident. And you're like, how do you buy a house on accident? Well, because I was successful in buying that first deal, that same realtor put out in the marketplace that I could close on another deal. And then she's like, just write offers. So I continued to write offers, and I was writing offers that were so low that I was because I didn't really want a house. I already had one. I didn't need another one. But if something's 50 cents or less on the dollar and you could prove it, why do you care, right? And that's really what was happening. Is I was just offering because she was coming at me. She knew I could close, and so she's writing offers for me. She called me on this one house. This house was legitimately worth about $220,000 fixed up. It was bank owned, and they were asking like $189 for it. And she comes to me and she showed it to me, and she's like, it need mostly cosmetics. It was one of the weaker houses in a really nice neighborhood. I had looked at several other houses in the neighborhood and tried to get one, didn't get it. That one had animals living in it because it was abandoned, but it's still a really nice neighborhood. So when she comes to me, she's like, what would you like to offer on this one? And I'm like, they want like 189. It was worth 220-ish. I said, I want to offer 93,000. She's like, well, they won't take you seriously unless you offer over 100. So we started out like 102. Now my maximum allowable offer, I had a formula, I had my numbers in play, I knew what the market, I knew what the house was worth done. My maximum allowable offer was like 123, 125. And this is all from memory. That's why I'm giving these broader numbers. So I go in, and I was actually testing the strategy at the time because a lot of realtors were saying, or having the bankers were saying highest and best, because you have more than one person competing. So people would negotiate hard at the beginning, and then when they got down to the end, they would say they would jump like 10 to 20,000 in the last offer because they thought they were going to lose the deal. So since I didn't want this deal or a deal, because I already had my deal, I wanted to test what it would be like to jump high first and then methodically only go up at a disciplined number and see what happens. Because in real negotiation, one of the things that happens is people go back and forth 2 or 3 times, and both sides want the deal done. Matter of fact, one of the strategies to look for deals is look for deals that just fell apart. A contract that just fell apart, those people thought they were getting their money and they were done. And they are annoyed, they want to close, you come in and offer cash on the barrel less than what they were going to take, but you can close quickly, they will take, you will sometimes get a better deal than what they were offering. This is what happened. So I ended up offering like 103. I tested the strategy, so I offered, I believe it was like around $10,000 the first jump, might have been 9, might have been 11. So I'm somewhere around 109, 111, I think it was 111,000 the second offer. And then I cut that in half. So I was at like 114, 115 there. From then on, as soon as I did those 2 moves, from then on, I only would move by $500. And that seems kind of weird, but I was just testing the strategy. So she'd call me back and then she'd say, what's your next offer? I'd say 500 higher. I'd just give her the new number. I wouldn't even say 500, I'd give her the new number. She noticed after about 3 of those that I was only going up by 500. So she calls me and I'm somewhere at like 115, 117 at this point. And she calls me and they've come down from like 180. They're down to like 150, 140. They tumbled pretty quickly. And each time I went up by 500, they kept tumbling more because I jumped that first jump to begin with, that 10,000 to begin with. So after like the second or third time I went up by 500, she's like, can you please just give me your top number? I will only move by 500 each time, which was a mistake. I shouldn't have given it to her. But she goes, I just want to, I don't want to have to call you every time you make it. I said, fine. I said, I can go up to 123. And then when that word came out of my mouth, I'm like, oh, I don't want to be close to mail, so I'm going to back it down. So I said, I don't want to pay more than, I'm like, no, I can't do 123. I can only pay 118. So she doesn't call me for 2 days. She called me, I think it was a Wednesday night. And she calls me and she's like, I got good news and I got bad news. I'm like, I always like to hear bad news first. So tell me bad news. She's like, bad news, you got the house. I'm like, what's the good news? She goes, you got the house at 118. So my number that I said she got it for, and she's gone back and forth with them. That house was legitimately worth $200,000. I ended up selling it several years later for $250,000 after doing two slight rehabs. The point I'm making on that is I would never have been able to buy that house without making those offers. So you have to make offers. You have to be comfortable with your numbers so that you can understand what to offer and then get in position to make those offers. The deal of a lifetime comes by every single day. Are you ready to pull the trigger on that deal? All right. So I'm going to wrap this up in a little bit, but the vital importance of that mail formula, choosing the market that you want to be in, because the mail formula it's really for single family houses. But in reality, those percentages are good on almost every single deal. And buying commercial deals and buying multifamily deals and buying land deals they're different, totally different structures as far as what you're looking at to be successful, timelines, ways to make money. But the mail formula in general can be superimposed. Looking for a minimum of a 20% profit is a good rule of thumb. Understanding that holding cost represents about 10% of value is a good rule of thumb. It keeps you out of trouble. That mail formula is developed to keep the investor out of trouble over long term. And then by actually understanding that you need those numbers to make that deal work, now you can start looking at what the after repair value really is. Most people are a little too conservative, especially in a market like this, of what the after repair value is. We're building out several deals, and the new houses that we're building right now have gone up somewhere between $50,000 and $100,000 while we're building. We won't put a price on a house right now until we're putting the finishing touches on the house, because we need to comp in real time, real comps at the time of closing or at the time we're about to sell it. If you guys are familiar with Zestimate at all, you'll notice that Zestimate is a little bit all over the board, but it does give an average of what value is, and it does move with what's happening in the marketplace. So I would never stick my value directly to a Zestimate, but I look at Zestimate because the marketplace is looking at all the buyers in the marketplace are going to Zestimate to at least get a feel for what they think that house is worth. And what's interesting about Zestimate is we had a house that we put on the market earlier this spring. It was a rehab. And it said that it was worth about $250, and the realtor wanted to list a little light, so I think we listed at $229. The marketplace, or Zestimate said it was worth 250 before we listed it. The moment we listed it, Zestimate dropped this number immediately to the 230 price point. So you got to be very careful about when you list a house, the timing of what you're going to put out on the internet, because once it's out there, that's what the internet actually replies to. And I couldn't believe, I'd never seen that. I never thought Zestimate was going to move down my number that quickly, but it happened in like days too. As soon as we listed it, 20,000 light, it was worth 250 all day long too. I think we ended up getting close to 250. But we should not have listed light because it made Zestimate fall. Zestimate is a good place to look at value. But if you so like, let's go back to that point of where I said, if it's 10,000 and you're worried about making 15, if it's 15, make it 20. The risk of making that number too out of whack prices you out of the marketplace to buy the deal. The other thing that prices you out of the marketplace to buy the deal is thinking the house is not worth what it's truly worth. So looking at how deals are done as far as the finished product. And by the way, all after repair values are truly after repair. You should be looking at every comp as, does this comp actually line up? Now you can say, let's say it's almost the exact same house, but yours has a brand new kitchen, the other one has a kitchen that's 30 years old. You have to take into account the fact that that kitchen is not brand new. So let's say it costs $20,000 per kitchen, and yours got brand new, and they just sold theirs for $200,000. Yours is worth a minimum of $220 because it has a new kitchen. Okay. In reality, it's probably worth more like $240 because the cost of the kitchen is the cost. The value that the new kitchen brings to the house is greater than the cost of the kitchen. So understanding that after repaired value is necessary. I don't start with any other numbers until I know what the after repair value is. So knowing that after repair value is huge. And then again, the reason you need those numbers is because you have to be able to write it off. If you never buy a property that you don't write it off. How to spot the deals is essentially understanding the importance of the mail formula, understanding the after repair value so you can get that mail number, choosing what market you want to be in, whether it's single family. Most people start a single family rehab section, just distressed property in general, because it's probably the easiest place to start when you don't have a lot of experience. Remember that I've never bought a property that I didn't make an offer on first, and consistently choose your teammates by whether, realtors, and by whether they're going to actually be able to get what you want done. When you get the right people in play, it's a lot easier to find deals. You can use a lot of different ways that contractors will find you deals. People will find, getting your name in the marketplace that you're interested in deals will help you find deals. Now, what is the value of knowing all this? It helps you to move into the real estate market, and we are looking at probably a 5-year shortage of real estate. So as fast as we can build right now, we won't catch up for 5 years. So deals are going to be in a growth phase across most markets. Now every market has its hole. There is a war zone, there is a dilapidated part of every market, and you should be very careful in those areas. But in almost every market I'm looking in probably 5 or 6 different markets across the United States, there is a shortage that's going to last 5 years. So knowing this stuff is very valuable. We are doing these investment live meetings twice a week right now. The next one will be on Tuesday. We're going to talk about finding deals and the importance of follow-up, because once you kind of have the information we gave you today, the next step is finding different ways besides just realtors of looking and finding deals. And I'll go over a lot of that detail next Tuesday. And like one of the things that we do is we offer a high rate of return for invested capital. So if you have capital that you want to get to work, we actually use private lenders such as yourself, and we pay 5 points and 7%. On our new builds, a lot of them are in the $400,000 to $800,000. I think the highest one we have right now is a fourplex at $960,000. So we'll do a round number of $500,000, kind of show you how that works. So if you come across the finish line with $500,000, you get a note mortgage tied to a real property that is loan valued at less than 75% of the after repaired value of the finished value. And the 5 points on 500,000 represents $25,000. So when you put 500,000 in, the 25,000 is attached to the face value of the mortgage, which means if I pay you back on day 2, I have to pay an extra $25,000. Then on top of that, you earn 7% a year. Now, you say, well, that's 12% a year. That is correct. It's actually 12.35% a year on that single deal. Why do we do it that way? Because you're earning 7% on the extra 5 points that are given. So that's why it ends up being 12.35%. But we want to reward our investors for coming back to us over and over again. And how do we do that? When we turn the money more than once a year, you get 5 points and 7% on the first deal, and you get 5 points and 7% on the second deal. So instead of it being, so if it's 2 deals in 1 year, it's 7% for the annual rate. And then the 5 points gets added to the first deal, plus a second 5 points because you're using the same money twice. Instead of it being 12%, it ends up being 17%. So if you have investor capital that you want to get to work, or you know somebody that has investment capital that wants to get to work, we do have a few deals left we're doing this year, and we can talk about that one-on-one. My cell number, you probably already got calls from me, because if you're on this call, you reached out to us first, and I probably been reaching back to you. My cell number is 608-306-1199. That's my live number, and I'll talk to you if you have any questions. Yeah, so we'll have another one of these next Tuesday, probably 2 o'clock again. We'll send you out some links. Also, if you, we're going to be sending out kind of a recap of this one, and then next Tuesday we'll be covering kind of the next step, which will be finding deals and the importance of follow, and how just by being in the marketplace and putting your name out there as you're interested in deals, how you can find these deals much faster. With that, I do have to jump off. We got another meeting I got to get to. Thanks for being here today. If you have any questions, again, my cell phone number is 608-306-1199. That's my live cell phone. If you don't get me, leave a message, I'll call you back. You can also check us out from the investing side at reir.co. Have a wonderful weekend, and hope we'll see you next Tuesday as well. Thanks again.